Wow, I want that introduction all the time. Thank you so much. So I'm really thrilled to be here with you today. It's a very exciting time in the cryptocurrency world, despite the latest price action. But I'm very excited that there is a group of you that have gathered to talk about investing in this new asset class, because I truly believe we are at the cusp of creating what is a new asset class, and it's going to require a lot of infrastructure. It's going to create a lot of opportunities for investors of existing sort of structures, venture capital firms, family offices, asset managers, but it's also going to create opportunities to create new types of investment models and new types of investment firms. So today what I want to talk about briefly is the future of investing and how we might start to think about new models for a new asset class. I would like to keep it very casual, so if you have questions, let's keep some time at the end to go through those. And I'll be around throughout the conference, so you're going to be seeing this face quite a bit. Would love to chat with you one-on-one about what you're doing, what you're working on. So with that said, I'd like to start by doing a quick little poll, just so I know who's in the room today. So who here represents a venture capital firm of some sort? All right, we have a few VCs, fantastic. Who represents the family office world, or is investing their own capital, perhaps? Okay, a fair number. All my crypto millionaires out there, great to see you. And then who here is here on behalf of a financial institution or an asset management firm? A handful. Okay, great. So we have a wide mix of investors. So hopefully there will be a little bit for each of you in here. And then, oh, most importantly, where are my crypto hedge funds? I know we have some of our crypto funds. Okay, fantastic. All right, what an exciting group. So I'm going to quickly start by introducing Digital Currency Group. I don't know how many of you here in the audience are familiar, but I thought I'd just take 2 minutes to highlight what we do and who we are. So when we started Digital Currency Group, our broad mandate really, and it was 2015 when we started, was to build a place where we could bring together Bitcoin companies, corporates, investors, to start to understand and define this new category of technology and to build an ecosystem around it. And so our goal since day one has always been to build, buy, and support digital currency and blockchain technology companies, leveraging our insights, our network, and our access to capital. So what that means is we went out and we raised money. Our investors are MasterCard, Foxconn, CIBC, the Canadian Bank, Transamerica, New York Life, Western Union, etc., some family offices, Bain Capital, which is a large venture firm, RRE, which is a New York-based venture firm that invests in fintech companies, and we really wanted to build a broad group of investors that could help our companies along their growth journey. So what we've been doing since then is we've built 3 companies that are 100% owned subsidiaries of Digital Currency Group. They are Genesis Trading, which is an OTC broker-dealer. They deal primarily in digital currencies. And they are regulated, which is pretty unique for this space. They're regulated by FINRA and the SEC, as well as the New York Department of Financial Services, which, as any of you in the space may know, has been particularly difficult to work with due to a piece of regulation called the BIT license. We also have a company called Grayscale, which is an asset management business. And the first product they created in 2013 was the Bitcoin Investment Trust. Today, that product has over $2 billion in assets under management, and we have 2 additional products that were launched in 2017, an Ethereum Classic Trust, which has around $150 million in assets under management, and a Zcash Trust, which has around $100 million in AUM. And the idea for Grayscale is really to create the PIMCO, or the wisdom tree, or the iShares of the digital currency space. So can we create an investment vehicle like the Spider Gold ETF that enables investors, both retail and institutional, to invest in digital currencies without having to custody the underlying? So you'd be able to track price appreciation without having to worry about all of the hard crypto stuff behind the scenes. So the idea for Grayscale is we're going to launch 4 more products in the next quarter, including an index product, which will be exciting for the market. And then lastly, CoinDesk. How many people here read CoinDesk? Everyone, I hope. CoinDesk is a media, events, and market data platform that we acquired in 2015. We were originally an investor. But the idea is that these subsidiaries generate cash flow. And we take that cash flow and we turn around and we invest it in 2 things. We invest it in portfolio companies. This constitutes both equity investments and token investments. And I'm going to talk a little bit about the distinction there and some of the challenges this introduces to the investment model. On the equity investing side, we've invested in over 110 companies companies across 30 different countries. These companies include Coinbase and Ripple, some of the earlier companies in the industry, as well as newer companies like Ledger, which creates a hardware wallet, Axoni, which creates blockchain-based settlement and clearing technology, and Brave, which is a browser which has a micropayments wallet embedded in it and has its own native currency now as well. And so the idea around the investment portfolio isn't really to be a traditional venture fund. We're a C Corp, and really the venture portfolio is focused on helping us gather data. We get private data from all 110 of these companies that help us understand what's happening in the Bitcoin and blockchain market, and to move to invest in those areas where we see our companies making new markets, making new opportunities. And so really the exciting part about our portfolio for me is the digital currency investing side. When we started out, we were 100% Bitcoin focused. So 2015, Bitcoin was the asset to own. Over time, we've diversified into a number of different assets. We disclose all of the tokens we've invested in on our website, and we were the first to create a token disclosure policy to start to define how investors might communicate to the market what their positions are and what they may mean for how they communicate. But that digital currency portfolio is really where I think a lot of the value is going to be created, because again, protocol investing is a new way for digital currency investors to participate in this ecosystem. So that's Digital Currency Group. Is that clear? Any questions on this model? All right, I'm going to move on then. So again, talking about disclosures, I think it's very important for people who are investing in this industry to be responsible stewards of the industry. And so I always like to disclose I've never been paid to advise or promote or market a specific project or token offering. My employer, DCG, we disclose all of our holdings on our website. And I personally hold all of these 55 tokens and digital currencies in my portfolio. They're also listed online somewhere. I can share that if anyone's interested. So if I talk about any currencies, this is what I own. I'm going to try to keep it as neutral as possible. I'm not going to promote any one specific currency or another. So I'm a fan of rap music, and Kanye West has this great song where he says, "That shit cray," as in, that is crazy. No laughs, okay. So I think tokens, this shit is crazy. Can I get a laugh? Like, it's absolutely insane. It makes no sense. So if we look at January 2017, just a year ago, January 17th, 2017, we look at the numbers and we compare them to today. So that's what I have here. 1 year ago today, the change is absolutely astronomical. So the first number I really care about is the number of digital currencies and tokens. About a year ago, we had maybe about 100. Today, we have 1,442, and they comprise over 7,500 traded pairs. That's insane. Like, if you're a trader, that's insane. That's a lot of market to cover. Last year, we had 2 cryptocurrencies that were quote-unquote unicorns or had a collective market cap of over 1 billion. Today, we have 31. Last year, the market cap for all cryptocurrencies was 6.5 billion. At its high, last week, 10 days ago, we were at 813 billion. Today, we're at around 470. We've taken a little correction, but it's still a massive, massive increase. It's almost a 100x increase, which is mind-boggling in any way you think of it. And then the metric I like the most, that I think is the most interesting, is we went from 70 million of notional traded daily volume, and that's just publicly exchanged volume, to over 61 billion at its peak 10 days ago, and today 50 billion. That's a crazy amount of growth, and you can see it. You can see it because the infrastructure in the digital currency space is straining. You can't get institutional accounts. You can't even sign up to trade because there's month-long waiting lists on platforms. What I love hearing about is Binance. Does anyone use Binance? Okay, okay, you're the degen traders, you're the degenerate traders, I like that. So Binance is a crypto-to-crypto trading platform that has its own token, and Binance opened signups for 1 hour. Just 1 hour last week, and in that 1 hour, they got over 100,000 new signups. That's insane. And they don't have 10x or 100x more employees to manage all of this either. So I just want to emphasize that the world we're in today is very different from the world we were in a year ago. So why are people buying tokens? And I think Julian talked about quite a bit of this, but I want to frame it in the context of the world I know, which is institutional finance. So the way I think about the blockchain development stack is there's really 3 layers. The base layer, really the core construction, is the protocol layer. And that's the actual software, the code, the rules of how these blockchains work. It's the consensus model, it's the monetary policy, and so each blockchain has its own consensus algorithm. Bitcoin uses proof of work, Ethereum will use proof of stake. People are experimenting with proof of space and time and other consensus algorithms. But again, there's a lot of variety here, and it really dictates the rules of the system in which we're operating. Then on top of the protocol, we have the networking layer. And the networking layer is the actual implementation of the software. So it's devices around the world running this code. It's people running the code. Again, in Bitcoin, you need highly specialized hardware. It requires a lot of capital expenditure. But there are new consensus models that people are experimenting with that could be really light clients that you could run, say, on an iPhone or your laptop, which is how Bitcoin used to be. And then again, at the networking layer, this is where the token incentive comes in. Because by participating in the network and validating transactions, you get tokens, and in some cases, fees. And then lastly, the layer at which we all interact with blockchains is the application layer. So anytime you're using a payment tool or a wallet of some sort, you're using an application. And these are typically built to serve a specific use case. And really at the application layer is where equity investing has been happening for the last 4 years, right? People invest in companies like Coinbase, and all Coinbase is just a wrapper around the Bitcoin network and now other blockchain protocols that allows people like me or my mom, who has no idea what a blockchain is, to interact with Bitcoin in an easier way. So what's interesting is in the past, the way that sort of innovation cycles would work is we'd have, everyone's seen this is sort of trite to share, but I think it's interesting. What we'd have is we'd have some innovators, crazy people. This was really Bitcoin from 2010 till about 2013. You would go online to Satoshi Dice. Did anyone use Satoshi Dice? Awesome. All right. It was a great gambling site. You could gamble with Bitcoin. Even Silk Road was an example of early innovators who were saying, hey, this Bitcoin stuff, what if we used it for things like payments? What are the ways that we could actually get utility out of a piece of software? Then we saw the early adopters, and I think that was really 2015 till where we're at now, where people started actually building the network. There are now hundreds of exchanges around the world that enable us to send Bitcoin from, say, the US to India, or from South Africa to the Philippines, and that wasn't really possible until the infrastructure existed in 2015, 2016. And where we're at now is retail investors have been driving a massive wave of investment into digital currencies. You look on the news in the US, I turn on CNBC. That used to be my go-to for stock market data, and now it's the crypto channel because you can't turn it on without hearing about Bitcoin. You open a newspaper, every day there's a new headline about Bitcoin or Ethereum or ICOs. And so we're really starting to see mainstream traction. Retail investors are buying it. Everyone has someone in their social circle who's created a lot of wealth through digital currencies, and so that further drives interest. Family offices and venture firms are trying to figure out how to get into the asset class because those in their peer group who've invested early on are going to have astronomical return profiles, and there's no way they can afford to miss it. And wealth managers, most importantly, and other traditional asset managers are coming to us and they're asking, what can we offer our clients? Because we're losing assets. Our clients come to us, they call their prime broker, they say, hey, I want to buy $10 million worth of Bitcoin. Broker says, sorry. What are they going to do? Are they going to sit on the sidelines and say, oh, I'll wait till you're ready? No, they're going to take that $10 million, they're going to pick up the phone, and they're going to call someone who can fill their order. So this is a real problem for institutional asset managers. So the way that I kind of like to think about the investing themes here is comparing it to the internet. So I was probably in middle school or high school when the internet boom happened, but I think the analogies are really interesting. So what we see in the internet is really it was an innovation in information transfer. But the first killer application was email. The ability to message in real time at low to no cost, right? And so as we think about the way that was built, we started with protocols. We then built networks, which was both infrastructure that was capital intensive, like ISPs, but also hardware that people ran in their homes, like modems and routers, as well as web applications. And then once we had all of this in place, we started to see this massive application universe grow and expand that offered all sorts of new functionality, leveraging the internet. Now, the interesting thing about the internet is if you wanted to invest, if I was Joe Schmo and I was a regular retail investor and I wanted to invest in the internet in 1999, I had no way of doing so except through applications that would IPO. So the early investors in the internet infrastructure were institutions and venture capital firms, and then retail buyers only got exposure to these assets until they IPO'd. So there was a lot of pressure to create investment products that would meet the demand for this new technology sector. If we look at what's happening in the blockchain's a little bit different. Analogous, but again, different. It's really an innovation and value transfer. And when I say value, I don't just mean monetary value. I mean things that have value in our world, whether that's implicit or explicit. So your browsing behavior is something that has value, right? Google sells it, and they make money off of you. So that's something of value that could be transferred and managed using a blockchain. But for now, if we just stick to the idea of money, really the killer app, the first application that proved this value transfer mechanism worked, was Bitcoin. And so the protocols are still being built. Bitcoin is still in a phase of growth. There's a lot of R&D work that needs to be done. There's a lot of second layer scaling solutions that are being built. Ethereum, same stage. We have other new protocols like IPFS that enables file sharing, or Blockstack, which enables domain name spacing. We then have networking infrastructure that's being built. So China kind of had the early lead when it came to mining infrastructure, but now we see infrastructure is moving abroad to places like Switzerland, to places like Iceland, places like the Pacific Northwest in the US where there's cheap power. And then we're going to start to see the entire application universe around blockchain technology develop, whether that's smart contracts, whether that's distributed computing, whether that's things like tokenization, which may not be possible yet today, but as the technology matures will become possible. But the interesting thing is, in this sort of stack, I can invest at every single layer as a retail investor. And in fact, retail investors were some of the first to invest in this asset class. So retail investors were buying tokens at the protocol layer. Retail investors could mine, and in fact, many people still do mine at sort of this layer. Not a lot of people mine Bitcoin personally anymore, but a lot of coins can be mined using just an ASIC chip or a GPU chip. And so it's still very cost effective. And then people are also investing in the applications. Now with tokenization and ICOs, I can invest in a number of different applications by buying these tokens. And so what's different here, what the question is how are we going to enable capital formation in new ways using this technology? Does that sound like an interesting topic to talk about for the next 10, 15 minutes? Yes? Okay. Look alive, people. It's Wednesday. It's early still. All right. So why is this happening? I think this is fun to talk about as well. So again, if we look at what happened in the internet, and really I like to think about the development of applications, web applications, and iPhone applications, there were three major themes. One, infrastructure got way cheaper thanks to cloud computing. Analogous story here in crypto is token standards and new platforms that allow you to easily set up tokens are lowering the cost of creating tokens because you no longer have to make your own blockchain, which is really hard. Second was social media. So social media networks enabled companies to communicate one-to-many and reach a really, really large audience of users very quickly. Same thing here. How many people are on Telegram? Everyone, fantastic. So we're on Telegram, we're on Slack, we're on GitHub. Thousands of people around the world are collaborating in real time to develop these projects, to market them, to evangelize, to connect with one another. This is a massive innovation, and it's really helping to fuel some of this boom. And I think the last piece that we tend to ignore and not think about is capital formation. So what we had in the web boom was we had a bunch of people who became wealthy. Operators who created startups that were successful during the web boom, and they created their own micro VCs, which have now grown into some of Silicon Valley's biggest venture firms, but they started investing in these early companies. In the crypto world, what we have is a lot of people who own Bitcoin and Ether early on are now extremely wealthy, and they're using their wealth not to buy yachts or Lamborghinis, although that joke is very funny. They're using their wealth to invest in new cryptocurrency projects. So this is the new form of operator-led venture activity. Now, what's interesting to think about is in the startup world, most companies fail within 3 years. And why do companies fail? They can't prove product market fit, or they've run out of money as a result of not proving product market fit, typically. In the crypto world, we haven't yet seen any massive failures of a crypto project because there's a large pile of cash that a founder has, and there's a massive stash of tokens to sell, and you can continue trading these tokens into perpetuity. So I'm going to pick on one token, and I mean it in good spirit. Look at the token Augur. Who here owns Augur? Okay, a few people. So I bought Augur in 2015 in the initial crowd sale. I think they raised around $5 million of Ether. And I bought some Augur, and I said, awesome, they're going to build a reputation marketplace and a prediction marketplace on top of Ethereum. Amazing. Put some money in. January 2017, no product materialized yet, but the rep token, which is Augur's native token, was trading at a massive premium to the price it sold at during the ICO. Today, I think one Augur token, rep token, is worth around $60. It hit a high of 120 2 weeks ago, but there's no actual product or service that you can buy or use with the token, but it keeps trading. So this is an interesting question. These tokens that we're buying through ICOs or through these new fundraising mechanisms, founders don't actually have any obligation to deliver us anything. And hypothetically, a token could have a market cap of over $1 billion without actually doing anything. Does that sink in? Does that sink in? That's a little crazy to me. And so what I like to think about is this really like investing in startups, or is this like investing in hot air? Because I think a lot of what we're seeing is just that, hot air, or as Julian called it, shitcoins. All right, so let's analyze data. I'm a mathematician. I want to look at the numbers. Let's try to understand what's going on. So I look at 4 key criteria. 1, how much capital is being raised? So how much money has gone into these projects, and what are the incentives for people to invest? Why are we seeing so many people pumping money into tokens? 2, let's talk about the number of rounds or deals that are happening, how much financing is taking place, and what's the general marketplace activity. 3rd is stage or maturity. So how long have these companies been around, and how mature are they just in terms of product delivery? And then the 4th that I think is really important to understand is the investor profile. So who are the types of people who are putting money into these projects, and what is their risk appetite? But more importantly, is there homophily or like-mindedness within an investor group? Because homophily can often create irrational market bubbles. So let's look at it. So where do ICOs fit in? So I looked at 4 types of investing, and I'm sure we could parse this out further if we wanted to. But the 4 types of investing I looked at were angel investing, venture investing. I put ICOs kind of between venture and IPO, but I'm not sure if that's the right designation. And then IPO investing, or taking companies out to the public market. So angel investing, let's look at the 3rd quarter of last year. So there were 450-ish angel rounds that happened. Companies raised around $2 billion. That implies the average deal size was around $5 million. That's pretty high. To me, that seems more like a Series A than a seed, but apparently seed is the new Series A, so I am clearly too conservative. We look at venture. There are about 5,600 deals, a total of $58 billion, half of which roughly was early stage, half of which was late stage. So the average deal size is around 10 million. And that feels right for a growth stage company, right? 10 million seems like a reasonable amount for a Series A, Series B company. Then we look at ICOs, and this is where things get really crazy in my mind. There were 86 financings that were done through ICOs in the 3rd quarter of 2017. Those offerings raised $1.3 billion, implying the average raise per offering was $15 million. Now, when we get to maturity, we're going to see most of these 86 companies have not delivered a single product or service into the market. $15 million on average. Sounds pretty good to me. And then lastly, we look at IPOs just as a point of comparison. So there are around 300 IPOs, around $40 billion raised, so an implied average of around 115 million. So again, I look at these numbers, and it's just shocking to me that you can raise more money with an ICO than you can with a traditional venture round. Is that shocking to anyone else? No, am I like taking crazy pills? I feel like I am. Maybe there's something in the water here in Switzerland, and I just need to drink more of it. Okay. The other question is timing, right? Time to market. So what we see in typical angel deals is it takes about 1 to 3 years for a team to raise serious angel money. And mostly it's early stage investing. The reason people invest is more conceptual. Maybe there's some product market fit. Venture, you're looking at about 3 to 5 years. You have to have some product market fit to raise a Series A or Series B. And typically when you're at a growth stage, you're about 5 years in, you've generated $1 million to $2 million of recurring revenue a year, and you're starting to scale your business. IPO, typically 7, 8, sometimes even longer, but it takes a long time to IPO and to go public and to create that type of liquidity for your investors and your employees. And typically, IPOs are reserved for businesses that are high growth, that have mature business models, and are generating a material amount of recurring revenue. 10 million a year plus, I would say, is the average. We look at ICOs. So again, I looked at the Q3 data that was reported by CoinDesk. They have a nice little spreadsheet you can download. Most of the projects that raised ICO funds in Q3 have been around for less than a year. Less than a year, and they're raising more money than you do at the angel stage or at the VC stage, and they're about 10% of the way to how much you can raise in an IPO, pardon. That's insane. Is that not insane? No one looks shocked. Nobody. Okay, I'm the most conservative person here. That's shocking. And what's crazy about it is people will put money into a project based on a white paper and a website. So, interesting new paradigm. So what does this mean for all of us? Well, what it means is we're seeing a lot of like-minded investors pumping money into these things. And this matters because when people start operating in groups and thinking in groups, we start to see irrational behavior. So what I looked at here was based on funding type, how many investors are there, what's the degree of homophily or like-mindedness, and what are the key trends and why this is happening. Does this all make sense so far? Everyone's following? Okay. So angel investing, tons of angels. The degree of homophily is very low. Angels tend to invest in their alumni networks, founders they already know, locations, or specific sectors. VCs, there tends to be a fair degree of homophily. There's around 3,000 VC firms, and they cluster typically by stage. So people will say, oh, we're a seed stage investor, or we're a Series A or Series B investor. And then in the VC market, what's really interesting is there are only really 3 or 4 firms, Andreessen, Sequoia, Benchmark, that are really pushing the envelope on what VCs do, and everyone just kind of follows. And I would love to say that's not the case, but I think that's a well-established paradigm. And then you have SoftBank, who's just coming in and showering money on everyone because they have $100 billion to deploy in the next 5 years. But that's a different story. In the IPO world, we have a very high degree of homophily because it's a tight network of people on the buy side. It's known players that you're taking these companies to sort of sell initial offerings to. But in the ICO world, what we have is we have a really large number of investors. But again, because of this social phenomenon of investors all hanging out in the same places and all of them already being crypto believers, we tend to see a very high degree of homophily, meaning they view the world in very similar ways. So what you have is this global network of people who are all communicating in real time about what they're investing in, and they're all investing in the same stuff. Okay, do we now start to see why crypto investing looks the way it does? We're all on the same chat rooms, we're all on the same telegrams, we're all reading the same tweets, we're all pumping the same stuff. So what does that mean? So let's talk a little bit about our role as investors. So it looks like about 2/3 of the audience is in an investing capacity. So what types of capital are you giving companies or projects you're investing in? Really 3 key types. There's financial capital, social capital, and human capital, right? So you're either deploying your capital or connecting people to capital that you have access to. From a social capital perspective, you're providing people with a degree of sort of validation and social signaling. You're saying, hey, I'm willing to invest in your project and attach my name to it. And you probably have a wide network you can connect companies and projects with. And then on the human capital side, you're probably experienced. You have a lot of experience maybe operating companies, being in the investment world, and you have other companies or other projects you're working with that you can use to draw insights from that you can use to help other companies. So kind of key types of capital. So then we look at the types of people who are investing. So we have all of these different types of investors. And today I would say people who are investing in tokens are probably limited to this top part of the chart, right? The most prevalent is individuals, and they're investing small amounts, and they only contribute financial capital. Angels and high net worth individuals are probably investing a bit more. And then really where it gets interesting is crypto funds, venture capital firms, and family offices, because they have social networks. And they're using these social networks to support the tokens they're investing in. But more importantly, if you see a major venture fund, or if you see a major venture capital firm or a crypto hedge fund has invested in a project, that makes you more likely to invest in a project. So there is a strong degree of signaling here that creates a really, really interesting problem around incentive alignment. And let's remember the role of an investor. what is the role of someone who invests capital on behalf of someone else? You want to generate returns that are higher than the risk-free interest rate, and you want to manage or minimize the risk of investments or preserve capital, right? So people who give you money say, hey, please don't lose my money, and please make it into more than what I would have earned buying bonds, right? Does that sound right? Yes? Okay. So the question for investors here this week is, does the risk of investing in digital currencies actually offset the potential outside returns that can be generated not just now, not just for the next month or 6 months or 12 months, but in the future, in the medium term and the long term? And I am not convinced that the answer is yes. And so I would love to argue with some of you about that. Talk, not argue, sorry. Okay. Lastly, I want to talk about investing strategies, because I know you're going to hear from a lot of funds throughout the next 2 days. You're going to hear from different people who are coming up with new ways to provide exposure opportunities. So I really tried to think about what is the risk you're taking on when you're buying different exposures to cryptocurrencies. The lowest risk strategy is to buy a structured product. That's why we created the Bitcoin Investment Trust. There's a new product called the Hold 10 Index Fund. There are a number of people who've created funds that make it really easy for very low fee to get exposure to these cryptocurrencies, and more importantly, they abstract out a lot of the complexity around custody, etc. There's futures, which are still fairly new. They're all cash settled, which I think's a little bit confusing and a little bit disingenuous. But the futures have obviously added a new product offering to the market. Then as we go to sort of medium and medium to high risk, we have crypto funds. So you can buy one specific crypto fund exposure. Metastable is an example of one that's more passive. They don't actively trade. They hold positions for a long time. They're very conservative in how they allocate capital. And then 3.0 Capital, for example, a new firm in which I've put some of my money, they make many investments. They're very aggressive and they actively trade. So there's kind of a spectrum. And that spectrum gets you different results. And so the model I would like to see is a fund of funds. So how can you buy exposure to 4 or 5 different funds that offer different risk profiles and different investing strategies? Because I'm not sure if an actively traded strategy or passively held strategy is going to generate longer term return. And then the highest risk activity really is trying to put together your own portfolio. And as someone who now owns 55 different tokens, I can tell you that shit is scary. I am constantly trying to figure out what's going on, checking up on my portfolio, reading, talking to people, and it's very confusing. Just custodying the tokens alone. I have a full-time security advisor, I have numerous hardware devices, I have all sorts of lawyers, and it's crazy. It's a lot of work. But again, this offers you the most control in figuring out how to allocate your capital. So the long-term picture is, look, this is a new asset class, digital currencies, tokens. The asset class is here. There's a ton of institutional money that wants to get into the space. And we're trying to figure out what the right infrastructure is, what the right competencies are that we should all have to effectively invest in this new asset class. Number 2 is we definitely need better investment products and better investment strategies. The model is not venture capital. It's not a crypto hedge fund, because number 1, a crypto fund is not a hedge fund, and number 2, because you can't short. And number 2, that's simply a passive buy and hold strategy in most cases. So what is the right product or the right service or the right strategy that will enable both retail and institutional investors to get exposure to this asset class with varying risk profiles? That's really the key. And that's where number 3 comes in. We need risk management tools and services. We need to have a way to help diversify investment portfolio, to reduce the systemic risk of investing in this asset class, but more importantly, to allow professional investors to actually touch this asset class, because there's no way it's going to get through your corporate review process. And then lastly, I think if we do those 3 things, number 4, we're going to see real institutional money start to move into the crypto asset class. So I went over, because I talk way too much, but here's my contact information. I'm pretty recognizable, it's pretty recognizable face, so come find me. Let's chat. I'll be here all week and look forward to seeing all of you. Thank you so much.